the chat session with the finance business partners and accounting job hub. Okay, so this evening we'll be talking on how to be an effective finance business partner in a startup. Okay, as you all know, startups are businesses that are in their first stage of operation and are usually faced with varieties of issues, which in most instances, the management usually need to provide solutions to in order to have a smooth sale for their products and service offering. So a finance business partner is responsible for the smooth and efficient operations of the business while securing its financial future. Finance business partners are important figures in any startup as they work with the finance department and various stakeholders in the business to oversee and implement major business changes, as well as use their various specialized skills in structuring the business's finances and planning the overall strategy and structure of the business. Not having a finance business partner in your startup business signals a bleak future. The need for an effective finance business partner in a startup business can therefore not be overemphasized. So in the course of this evening's session, our guest, Mr. Jinadu George, who is a finance expert and a familiar figure to some of us due to his prowess in finance and his impact through the finance business partners community, will be practicalizing to us how to be an effective finance business partner in a startup. So the session promises to be insightful and engaging as usual. Do enjoy your time with us this evening. And if you are joining us for the first time, this session is coming to you via the collaborative effort of the finance business partners and the accounting job hub. So if you would like to engage with us on a daily basis during the course of the session, we would have the link to our various platforms in the chat box, and you can always join in to any of our platforms. And if any question arises during the course of the session, do make use of the chat box so we wouldn't have to distract our facilitator this evening. So Mr. George, good evening.
Hi, good evening, Idris. Thank you for the opportunity today. Thank you, everybody, for having me. As much as possible, I'll try to be as practical and try to share some insights which might be helpful for some of us. I think, like Idris mentioned, I've been actually on that side of the fence. I've been an FVP and I've done a bit of work with startups. So one of the things that's prompting this conversation is for some of us who read LinkedIn, who visit LinkedIn, visit some other sites, you'd have heard some news about a couple of startups, Oh, people say, wow, they don't make profit at all. Oh, the losses are huge, what kind of, maybe it's a scam business, how are they making money? So it's very important for us to understand the business model for every startup. And I think that's one of the key things that differentiates a finance business partner from the average accountant or an analyst. If you have the right skill sets on knowledge and understanding, and also, very importantly, have the right mindset, because finance business partnering is more of a mindset, not just skill set. And I think that's one of the things that would differentiate a finance business partner from your accountant and your analyst. So we dive into today's session. I'll try to show you a short presentation and make it easier for. Let me know if you see my screen.
Yeah, your screen is visible.
Okay, great. So today we'll be talking about how to be an effective finance business partner in a startup. And for us to go into that, I think the first thing we need to do is we'll run through the key areas today. It's a very broad topic. It's a very huge conversation that can take a very long time. But as much as possible, we'll try to focus on the key elements that will be very important for you, that if you take that away from this session, it changes how you see some things that you may not understand. So today we'll be talking, the first thing we'll focus on is to define what a startup is. Then we'll also try to understand the 6 stages in the life cycle of a startup. Then also understand the 3-level business pyramid, what some people call a playbook or some call it a business model for a startup. Then we will try to understand who a finance business partner is, because it's very important for us to know who a finance business partner is. Then from there, we see what are the key competencies that a finance business partner needs, to be able to be successful, effective. Then we now try to do a comparison between who a finance business partner is versus who an accountant versus a financial analyst. Then from there, we'll go to the question and answer session. So I go in straight and try to define what a startup is. So I try to go on the internet and see what are the definitions some people have given a startup. So the first one from Investopedia, it says startups are companies or ventures that are focused on a single product or service that the founders want to bring to market. These companies typically don't have a a fully developed business model, and more crucially, lack adequate capital to move on to the next phase of business. Now, I think one of the key things we need to pick up from this is the startups. Many people may not understand or know this. The focus of a startup is at the beginning only one product. Yeah, you can see a startup do like 5, 6 different at the same time. But one thing I tell you is the focus when they start is just one thing. Like, what can we focus on? What can we do better? What can we improve on? Then the second startup is a company typically in the early stages of its development. That's another keyword there. It's in the early stage of its development. They just starting, trying things out, they don't have everything figured out yet. They don't know where they are. They are not the big organization that have a proper structure, department and everything. Just trying to keep company or project undertaken by an entrepreneur to seek, develop and validate a scalable business model. And if you understand this definition, it will make quite a number of things easier for you in working in a startup. So for me, what that means is, firstly, startups are, created by entrepreneurs. And if you understand the mindset of an entrepreneur, the mindset, and in finding that problem, they try to solve it. And in trying to solve that problem, they try to make money while solving that problem. So what you see is entrepreneurs don't probably have a defined job. So their job is, okay, maybe they go to a particular place in the morning. They wake up. You wake up in the morning. You see, let me look for a typical example. You stand at the bus stop every morning. At the bus stop every morning, 7 a.m., 6 a.m. People are complaining, hey, no bus, like everybody's just complaining, no transport. What a typical entrepreneur will do in that situation is, what if I can create an improved transportation system whereby I can solve this 7 a.m. People jam, that there's so many people, fewer buses. What if I can either create that and also make it cheaper and more effective? Can I make money doing it? That's typically what an entrepreneur do. An entrepreneur sees that, people, every time you want to buy something, you have to leave your house and go to the market. An entrepreneur is thinking to himself, what if I can build a website where I can also post this stuff and people can actually place an order on that website and buy, and that thing gets delivered to them. So I've solved the problem of people having to leave their house to go and buy the same thing if they can actually get it for the same price or even a better price at the comforts of their home. So typically that's how entrepreneurs think. I put a diagram by the right just to give you some perspective, but I think that's not necessarily for you to fully grasp today. Try to give you a differentiation between what a startup is and a scale-up is. But that is beyond today's scope. But with time, by the time you dive deeper into understanding how some of these concepts work, you will be able to go do your investigation and understand it better. So in the next slide, we talk about the 6, the 6 stages in the life of some of these things before. You may never really understand what it means, but you sort of have an idea. Okay, you would have heard something like seeds. When you hear all these people on LinkedIn or Medium, you just raise $1 million pre-seed. Or just getting money, Series A, Series B. Even I was confused before I started getting into the space to understand it. So every entrepreneur, every startup goes through 6 generation to the stage of what you call the exit. Now, the first stage is the pre-seed. Pre-seed typically states here the focus at this stage is to identify a problem and find a solution. Typically, yes, also known as idea creation. So when you see people at pre-seed stage, what they have mostly is a PowerPoint presentation. You have somebody telling you, I'm building next Jumia, I'm building the next biggest digital bank. So what they have at this point is an idea. They've seen it. They've stood at the bus stop every day, see people there 7 a.m. and tell you that I can build a website whereby people, or an app whereby people transport every morning and a vehicle will come by 7 a.m. and pick them up. No off structure yet. No. They just have the idea. They just have so much conviction. They just have so much dream, vision, and putting in that mindset, doing more research, trying to figure it out. So investment, because what you don't have anything to show anybody. So they typically raise very small money, get investors from maybe a small amount of money. So there's a running joke about this stage in the startup world or investing world. They said they raise money from what you call the FFF, triple F, meaning family, friends, and fools. So what does that mean? It means that at this stage, the only thing you have is an idea. Who would give you money? The bank will never borrow you money. It's not going to happen, A bank is not gonna give you money. When the banks don't give you money, who typically will give you money? Sorry, hold on. So who typically will give you money? There are the 3 Fs: your families, your friends, and people we call fools. Because at that point, the risk is high. People can give you, is it clear now?
Okay. Yes, it is.
Okay, great. So the kind of people that will give you money are the 3 Fs: your family, your friends, and fools. Maybe your father, your mother, your sister, wherever it is, and your friends, your close friends. This guy has an idea, but we don't know whether it will work or not, because you've not built anything, they've not seen it, they don't understand what it is you're trying to do. You just say, okay, let me just support him or her so that he will not die of frustration, or she will just not, get miserable at the end of the day. That's the pre-seed stage. Then the next stage is when you've raised some money from the, what do you call it? The pre-seed stage. You move to what you call a seed funding stage. So at the level of seed funding, it's very close to pre-seed also, but at seed funding level, you now have an idea. You've done more research. You have a general understanding of what the problem is. You're trying to now properly define the solution to the problem. So here, the discussion at this stage, the founder or founders have found out what they believe is a solution to the problems identified and need to validate it. They start to build the business. So at that point, you start to get people with you. Like, okay, people come and work with you, people who trust you that, okay, look, I believe in this dream. Just give me 3-5 years of your life and I'll make us very rich, blah, blah, blah. So at that stage, you started building something, but, maybe you started developing the website. Not perfect yet, but you have something. You started building the app. You have something that you can show and see, this is what the app will look like when it's done, blah, blah, blah. Or even if it's a business, you now have small shop. You've designed what kind of shop it is. You started discussing where you source your products. You have all those kind of things documented. So at the seed stage also, you still get people that they call angel investors that give you money, to start. People, okay, this guy has a good idea. I like what he's doing. I have an idea of what he does. I think it's perfect. Let's put some money in this guy, So when you are good with that stage, then the next level is what you call the early stage. Now, early stage pretty much is now you've designed what you call your MVP, your minimum viable products. Minimum viable product means you've built something, the app is working. You've tested a couple of times, it has failed, but it's now working. You open the shop, you now have people coming to the shop, like you have where you buy the products to sell. You're live pretty much. You are there. People can see the products, You may not be making good money or anything to test it out, like, okay, this thing is working. I can actually place an order on it. I can actually book a ride. I can actually buy stuff from this shop because it's really unsafe. So you've gotten a couple of things happening, traction happening in your business. At this stage, you get investment from what they call the seed round. The series round. So that's where some of you may have heard things like Series A, Series B, Series C, till Series Z, whatever they want to call it. Meaning that now at this point, there's what you call a valuation, a priced round in investment or corporate finance. Priced round means, so at the first stage, people just give you money. Take $5,000, take $10,000, take 1 million naira, take 2 million naira. Go and start. If he survives, fine. If he doesn't, go do that business. But in your mind, it's okay. This person that gave me this money, when this business is okay, I'll give you 5% of the stake of that business. Seed stage also, you get people to give you money, but there isn't money. There's nothing yet. But these people see what you are doing, they trust you and believe that one day you'll be there. So what typically happens at seed stages, you use what they call a safe. I'm going to use a couple of terminologies you might not be familiar with initially, but over time, by the time we have subsequent sessions or by the time you do more research, it will start to make more sense to you. I'm just trying to lay the foundation for us to understand where we're going with this. So at the seed stage, there's no valuation also, there's no pricing. They just give you money and give you what it means, standard agreement for future equity. Meaning that, see, I'm giving you this money today. I know you don't have a value for your business or price, whatever. However, by the time you have a value for your business, you will give me at a discounted rate. Meaning, today I've given you 1 million naira. I'm estimating that your share should be one. We can't agree to 1 naira. But by the time you are doing your next getting funding from people, I will use that price at a 20% discount, meaning that people buying at that price, if they are buying it at 1 naira per share, you will give me a 20% discount, meaning that I will buy it at 80 kobo per share for the same. So you have those kind of agreements in what you call a safe. It's just a document like, okay, standard agreement for future equity. That's what it is. Then the early stage is where you start the series funding, whereby it is now properly priced, where investors say, based on your business, the way you built it, the way you have the platform, the way you have customers, the type of customers, we are projecting that this business in the next 5 years will be generating this amount of revenue. And when the business generates this amount of revenue, it will be the value. Therefore, you have all those technical conversations in terms of pricing, in terms of shares. Okay, you'll give me this money for me to move to this level and all that. That's where you have all your series A, B, C. Just the first steps of your series. Then after the early stage, you now move to the growth stage. Now, growth stage essentially is you figured it out. It's working. What you see commonly, you have a lot of startups who, after they've built, for example, you can maybe what do you call it, Flutterwave, or Jumia and Co. So when they typically start, they start in one country. By the time I can grow my number of customers, I can make more people use my platform, generate more money. So they focus on getting more and more and more and more customers rapidly, just to keep expanding. And when they've expanded to the full local market, they start to think, I can do the same thing in Ghana and do all that. So at the thousand to 1 million, 1 million is 10 million. You just keep growing and growing and growing. Then from growth, you move to the expansion. Expansion is where typically you try to replicate it across multiple markets. Also a tech hub, go to in Kenya, you solve the same problem in South Africa. So at that point, you are also bringing in efficiency by trying to hire people who know structure, process, start to place right people in the right positions and to do that. Then the final stage in every business is what you call the exit stage. This many people may not know, but every single business in this world has what you call the exit. So typically exit comes
Yes,
in
sir.
multiple ways. One exit comes in
Sir?
okay. Typically
Yes, yes.
typically exit comes in multiple ways. One, you can sell off the business, which is what some people do. The founders decide to sell part of their share. Sorry, can you mute? I think someone needs to mute. Okay. So typically at this point, you sell off to other investors. The early stage investors sell off to make their profit. The next set of what exit option is what you call an IPO, initial public offer, where you take your business to the stock market and get people to buy. The whole idea of exit is this. Don't forget, at the precedes to say to early to growth stage, you have investors putting in money, putting in money, putting in money. The concept is that they are putting in money not because they love you or anything. It's an investment. At some point, they expect the money to grow or the value of your business to grow. And when it grows, they expect to be able to sell it. So when they sell and take their profit from it. So typically, you see venture capital, you hear things like venture capitalists and all those kind of people, they look for 10x, meaning that if you put 1 million naira in your business in 5 years, huge profit from it, but it doesn't always work like that. That's a conversation for a different day. So when we understand the 6 stages in life cycle of a startup, then we'll move to what I like to call the 3-level business pyramid, or what you call an entrepreneur's playbook. Now, this essentially categorizes every entrepreneur or business into 3 categories, what they are focused on. First of all is the product-focused businesses. So first-time entrepreneurs or first-level businesses focus more on product. They try to keep, making corrections on the product. So Uber, this boat came, boat look entrepreneurs or second-time entrepreneurs. What you see them focus more is distribution. They don't spend so much time on products. They know that, okay, once the product meets that minimum MVP level, minimum viable product, their focus is how do I put it in the acquire markets? Like, people keep using it. What do I do? They focus more energy on that. They are not interested in the cheapest whatever at that moment. The goal is, now I have these things. How do I put in the hands of 1 million people, 2 million, 10 million? So that way I can see a scale. Then the third level of it, or in the business model, is value chain focused. That's the bigger and larger organizations that you see. Their focus is efficiency, meaning how do I go up or down in value chain? So what you see here is what you call the vertical integration. That's, for example, like you can have a company, maybe, let me look for a typical business. A typical business who buys and sells maybe phones, for example. Yeah, you've built that product. Let me not even use phones. Maybe retail generally. You started out as a retailer. You have a shop. You buy and sell. You buy and sell. Then you're buying locally and selling locally. You've figured out how to get customers to come in. By the time you're thinking of value chain, the next level for you is, why am I helping other people buying and reselling their own product? Why can't I build my own product? So you move up a step in the value chain by this. So now going into who a finance business partner is. Now we've set the context of what the startup is, what are they doing, how do you even differentiate it? So now we need to even define and understand who a finance business partner is. So I went and saw a couple of definitions, and I think these two struck me most. And so I read it out. First of all, the first one, which was somebody on LinkedIn, I can't remember the name, said finance business partners are accountants getting a real and active partnership with both operations and management. Then he now further said their role is to provide real-time support and analysis, to be a trusted advisor, and to add value that will assist in decision making. Honestly, it encompasses the full definition of a finance business partner. But for me, it's too much grammar, it's a bit difficult to digest for me. So I went around and I saw there's a guy that I also follow on LinkedIn, Andrew Jepson. He also coincidentally runs a forum called the Finance Business Partners, and he's in Australia. So he does some trainings and all that for them. So I looked at his own definition, and I think for me that strikes me more. He says accountants use tables of numbers, business partners don't. So finance business partnering is about three things. One, building relationships. It's a finance business partner focuses on relationships. It's not just by numbers or anything. The relationship is key, and you'll see why very soon. Number two, turning data into insights. So there's data, there's profit and loss. A typical accountant will submit P&L, balance sheet, cash flow, tell you IFRS 15 says this, IFRS 9 says this, IFRS that. But don't forget, salespeople don't know what IFRS anything means. They don't care. They just want to sell. Or, the CEO, probably not even an accountant, doesn't care what IFRS 1000 means, So you're just showing him his P&L, what has happened. Okay, now that I know what has happened, what do I do with it? And the third part of his definition is number three, bringing numbers to life, which for me, I think is the crux of being a finance business partner. How do you put life in those numbers? How do you explain to the business owner that, Oga, we've been making this as our performance for the past 6 months. This is telling us to do this, so we might need to do this. How do you do that? I go on to the next slide. I try to give an idea of who an FBP is, a finance business partner. So a finance business partner is a little bit of these three key roles. He or she is an accountant. He or she is a commercial finance manager, meaning that you understand commercials. You don't just show P&L. You can speak to a salesperson, a procurement person, analyst, meaning that you can take numbers, analyze it, and dig a bit deeper into it. So these are some of the key competencies. Like I said earlier, it's about finance business partner is about the mindset. It's not just skill set. There are certain skills you need to have, but you also need to have the right mindset to be able to function. I took this from a company called Excel Consulting Pte Limited. I like it because I like the way it flows. So on the left side, you see what are the skill sets you need, commercial and organizational acumen. So you don't just tell them IFRS alone. You understand how sales work. You understand how customers are acquired. You understand how every single customer impacts on the business. Then you have communicating to influence. And I think this for me is the biggest thing that differentiates an accountant, an analyst, and a finance business partner. Ability to communicate to influence. You're not just throwing numbers. Will people listen to you? Would you be able to influence the decision or direction of the owners of the business with your knowledge, with what you've seen? Then the next one, relationship and stakeholder management. Very important. You need to learn how to build relationship, which also still follows from the communication part. How do you manage different people? How do you and decision support? Very important. You need to have insight based on numbers, because numbers are facts. You need to be able to do that. Negotiation mastery. People don't understand this. I say the work of a finance business partner is like the work of a politician, not just the accountant. You can't lean totally towards one side. You can't say, okay, I'm an accountant, this is the way it is. You need to learn how to negotiate. You need to understand, you need to have some negotiation skills. So it means you might do a bit of reading
around negotiation skills. Very important. You can Google search. I think there are a few courses or few topics around this. It's very important that you read about how to negotiate, because when you are presenting your information and trying to influence people, you need to figure out, okay, what do you put on the table? How much do you put on the table? Where do you bend? And, where do you adjust? Strategic thinking. You think long term, not just, oh, this is good now. How does that impact the next 6 months, 12 months, 2 years, 5 years, wherever you work? You need to think long term. Global mindset and adaptability, meaning that your decisions or your thinking, you have to be global. You don't just sit in your isolated small world of the company you work. You should look, how do other businesses similar to your type of business operate, and how do they achieve what they achieve? Then technology, very key. You can't walk in today's world without appreciating technology. You cannot know how to use PowerPoint to present, for example. You need to learn. You can't know how not to use Excel. You can't be punching calculator everywhere or carry your biro and paper and be doing, what do they call those things that children do? No, you have to use technology. Then you also need to know how to use tools. Nowadays, you have some analytical tools, some visual tools, basically things like that. Even research, you need to know how to use Google and other tools to do your research. Then in terms of mindset, intellectual curiosity and continuous learning, you have to keep learning, because business is dynamic. It changes every day. So you need to keep learning, seeing about other people. And the world is becoming a global village after COVID. You can see, you can be living in Nigeria and working in Australia. You can be living in the US and working in Nigeria. Nowadays, you have those kind of things happening. So you need to, be trying to learn how to adapt in those kind of situations. Your focus should be on action and problems, argument and just typical, oh, I know it. No, it's not just about reporting. You can show the reports, but if no action is taken to solve a problem, then you're not meaningful. Agile decision-making and calculated risk-taking. As a finance business partner, you need to be agile. As quickly as possible, you take the action, you need to take calculated risk. You need to be confident, and you need to understand maturity to challenge, to have maturity pace. You have to be confident and challenge people. If it doesn't make sense, it doesn't make sense. Coping with ambiguity and championing change. What that pretty much means is you don't have all the information. Just have an idea and chase it. You should be comfortable with not knowing everything. It's normal. You can, but you must have an opinion and engage and discuss and negotiate. Then when you engage with people, your opinion will help you be able to, by the time you interact with people, you will form and shape your opinion better and be able to take proper decisions, with your opinion and your ideas. Then stretch beyond your comfort zone. That's very important, because if you want to grow, remember, you are not just a finance business partner for the rest of your life. At some point, you need to grow up the ladder. You need to move to the CFO level. You need to move to COO level. You move to CEO level. So you should be able to stretch beyond your comfort zone to have more understanding of how things work. And at the same time, once you have that more understanding, it will prepare you for your next big thing in your career. So this I'd like to call the quick analysis or summary of what differentiates a finance business partner, and financial analyst and an accountant. Sorry, the last thing at the bottom of the pyramid is actually an accountant, not an FDP. So what am I trying to say here? An accountant focuses on what happens. Accountant gives you P&L, balance sheet, cash flow, gives you this month versus last month, this year versus last year. That's what accountants do, and send you that P&L report, your performance report. This is what has happened. Okay? Picks up that information and goes further and say, okay, yes, our sales grew by 20%. However, it grew because we had more new customers than old customers. It grew because a particular customer spent more money buying a new product than this, so it's a one-off reason. Or it grew because we just introduced a new product and we had more people buying it than the others. Or because we increased price in a particular product. That's what financial analysts do. They pull out that information make a nice fancy presentation with it and show you. Like, they dig a little into the details to give you more information. But the finance business partner, which is, I said, it's more of a mindset, focuses on what to do with the information that both has created. So now we know a financial analyst will tell you, okay, we had 20% more return customers than this. They'll do those fancy graphs, charts, shows you. But to be a proper finance business partner, you need to now make recommendations. That's what pushes you beyond the two roles. So you still need to have the skill of being an accountant. You need to have the skill of being an analyst. But at the same time, how do you put that together and advise the business? It's very important. You need to be able to say, okay, I have all this information. What is it telling you of this, or to avert that future problem? So this is how the three levels are differentiated in terms of what they do. And I think at this point, let me see, before I go to Q&A, let me bring us back to something that I think that's very important, and is this slide. Now, the key importance of this slide for me is what will define your success as a finance business partner in any organization you work in. So now, the first thing is this: you need to understand what stage the business you are working with is in. Because the stage determines the kind of value and advice you provide to the business. It's not just saying, oh, okay, yeah, I'm a finance person, a P&L. So I think I need to bring, this is all my opinion. This is all my perspective based on my own experience of working with some of these organizations and seeing some of these things done in the past. I saw an article recently talking about one startup, I think, in particular, Kuda Bank. Somebody posted something and said, they made the 6 billion naira loss, over last year. Like, they've been saying banking for free. What is free? They made 6 billion naira loss. Then I've seen articles too in the past about Jumia. Jumia is not making profit, or is making a loss. Typically as an accountant, it doesn't make sense. Like, we're all accountants, we understand it. Why would a company be in operations and be making loss and not even thinking of making profit? So I've been privileged to work in a startup e-commerce, the early days of e-commerce, when e-commerce was just starting. I've worked with both Dealday, then it's no longer in existence. I work with Jumia, and I've had relations with Konga. So you'll see some things that maybe the founder will wake up and say, free delivery to across the country, across Nigeria. Any item somebody buys is free delivery. I'm wondering, like, because I was shocked too this was my own first real experience with it some years back. And I'm wondering, somebody is buying something worth 1,000 naira from Lagos to Maiduguri. The delivery of that item is 3,000 naira. Delivery. The profit on that thing of 1,000 is maybe 200 naira. And this man is saying do free delivery. As in, has he lost his senses? Has he gone cuckoo? That kind of thing. And so the accountant in me was, no, this doesn't make sense. It doesn't make sense. It can never make sense. Why would you be throwing away money? Blah, 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 blah. That was my first experience, like I said. So I didn't know. It was just me fighting it. But it took me a while to understand that every business is in a certain stage of its life cycle, right? If you understand the stage the business is in its life cycle, you will understand the type of information or KPIs to measure. You don't measure the same type of every type of business. What am I saying in essence? The very early stage startups, year 1, year 2, most times don't care about profits. Don't forget, at pre-seed, you just have a presentation. You just have an idea. You don't even know what it is. At seed stage, you now have, you're starting to build the business. So it doesn't make sense for an accountant to be telling you, oh, God, we're making loss month and month. Of course, you're going to make loss. You don't even have a sale. You don't have a revenue yet. So it will rattle the accounting bone in your body like, why are we not making money? We need to be making money. This thing we can't be giving it to people for free. When you get to early stage too, you see that as being common. They have the product. They are saying people should come and do it for free. For example, let me use a typical scenario some of you might know. Kuda Bank tells you transaction fees are free. There's zero transaction. And it's true, they don't charge you anything. But do you think deep down it's free? It's not free to them. They're paying for it. There's a cost assigned to every transaction. There's the switch, NIBS, who powers settlement of funds. And they charge them 5 naira for every time you do a transfer to other banks. Maybe you don't know. But they're taking in the cost. But because they're at a stage where they are still at the early stage, they have the MVP. They are trying to grow. They are trying to scale. The focus at that point is not profit. The focus is more of customer acquisition. The focus is more on experience, because the more people use it, the more they make modifications to their business model. The more they improve on the product, such that by the time they now get it up and running properly, they now focus on the expansion stage, and then they can now start trying to see how do we make good money out of this. Now, why I'm saying this is this. If you understand the stage the business you are working for is, you understand the kind of KPIs you focus on to sell to that business, then that will automatically make you an effective finance business partner. Because don't forget, a finance business partner is what? Is a person with finance knowledge who is partnering with the business to help cover whatever gaps in the finance side of the business is. Accounting, analysis, but what are you telling the owners of business? How are you helping them to achieve the vision, the mission of the business? So don't tell a very early stage startup you are making losses. He knows, he doesn't care. Because at that point, he's trying to build something that he knows. Let me give you a typical scenario. Amazon, some of you know of Amazon. Amazon made loss for 10 good years, not a single profit. Were they not making money? Of course they were making money. They were making money, but they kept on reinvesting in expansion, market diversification, and all that. The Facebook that most of us use today, do you know that Facebook did not earn a dime for 7 years? There was no single revenue for Facebook in 7 good years, not a dime. And they kept on getting investors to put in more money because they were building. They were building, acquiring customers, acquiring users, modifying the business. When Facebook started, it was just a web page. Everybody was on the web. But later they built a mobile app. Then later they acquired WhatsApp that we all use. They acquired Instagram. So every business is at a particular stage in its life cycle. So to be an effective business partner, you need to understand what stage is this business I'm working in its life cycle. Then when you understand, and it's always easy for me, it's about how the language they use and what the owners focus on. If you see somebody focusing on cost, we need to improve costs. Know that they're no longer at the early stage. They are mostly not even at growth. They are probably at expansion. So they will probably cross between the growth and expansion stage, because at that point, they've built the product. So you know that at that point, your focus as a finance business partner is how do we bring in efficiency to save costs. When somebody is talking about we need to acquire customers, we need to spend a lot on marketing, don't tell the person how your P&L, your loss by this month is worse than last month's loss. Those kind of things. It's not going to help the person, because the person knows that, okay, I figured it out. I need to quickly hit the market. Because one thing about business that finance people may not really know sometimes is, forget the fact that you think this person is doing this thing. Take it from me, there's no new business idea. There's somebody somewhere who's thinking about it at the same time as you, and there's somebody somewhere with a lot of money who doesn't want to go through the risk of taking the testing the market. Once they see that you figured out how to build it, they will copy you and run as fast as possible to hit the market. Not all the time that succeeds, but if you're not careful, it will stretch you out. So the reason for me emphasizing on this slide is, you need to understand what stage of the business you're working for is, or the business you want to work for is. You need to understand what is important to them, what is their vision, their mission is. That way you can now be able to help them measure the proper KPIs, and also be able to provide a good advice as a finance business partner. And that's what makes you effective. You are not just accounting, giving them P&L balance sheets of what has happened. No, you're not just telling them more return customer versus I think last month we spent X amount on marketing. From my engagement with the marketing team, it got more customers in these areas. Those customers bought this value. Search, I realized that people there, maybe the average income of people in that particular area is this. Don't you think we should be doing this? Because our numbers also showed it. The customers that bought, this is the average income. That's what the finance business partner does. Don't you think at this point we should be, because we started generating maybe, when we started buying 50 products from seller A, vendor A, but now we're steady at buying 500 products from vendor A. Don't you think is credit terms so that we can use their money to trade and do more business? That's how finance business partners work. Not just say analysis. Okay, every month vendor A supplies us 300 units. No. What should we do when we know that they supply us 300 units? What should we do with that information? We should be thinking, okay, we need to engage vendor A to get credit terms, because at this point, we are consistent with doing that. Or we need to go back to vendor A to say, hey, can you sell these things to us cheaper if we commit to buy this quantity every month? Those are the kind of things the finance business partner brings onto the game. So with that, thank you very much. Any questions?
With my question. Okay. So during the course of your presentation, you mentioned that even at the early stages that there may be rise to maybe cost and losses, and the owner may not really be concerned about making losses in the first few loss at the very onset. Don't you think that, okay, as a finance business partner, that we should be even more concerned about cost and we don't have revenue yet? What return, this particular cost that are being incurred, what return, or what is it actually going to be viable at the end of the period? Let it not be that, okay, the costs are just being incurred and at the end of the day, the business may not even be viable after all.
Okay, good question. For every business, there's a certain level of risk, right? And when you talk of risk, no, there's no guarantees that a business will be viable. Now, there are three key questions when an investor is asking you, or whoever it is that's giving you money. First thing they will ask you is, what problem are you solving? That's one. Then two, they will ask you is, is it profitable when we eventually solve it? Two, then the third question they will ask you is that solution scalable? Like, what's the maximum number of people you can solve that problem for? Now, for every startup, and that's why you see most time when you hear the statistics, 9 out of 10 startups fail, which is the truth. Startup starts with emotional attachment to something. You just see this thing. I can build this. If I build this thing, I have 1 million people. I have risk of the business might die, might not succeed. And that's why each business is at a certain stage of its life, And that's why I mentioned something, if you remember, at the early stage. I said the pre-seed stage, the kind of people that finance it are what you call family, friends, and fools. More like you call emotional investors. Emotional investors, okay, is my brother. This guy that's doing this thing now. Let me know if I don't give this person this money now, the person might commit suicide, or, let's just help. The person is sitting down, not doing anything, smoking igbo, whatever. But let me invest in this person. At least he will find something doing, or she will find something doing. That's what you have at that level. The risk at that level is extremely high. And that's why most times, typically, you see very small investment coming into the business. People don't really put money into it that much. They just give you a little to figure it out. At that point, remember, it's still idea, PowerPoint. It's just you having money to go around to be able to see if you can build relationships. Then the next stage there is the seed stage, whereby, okay, you've designed it, you have the idea, everything makes sense to you. The same thing is still high risk stage, where you have people like angel investors giving you money. What angel investors do, some of you can do your research later and understand what angel investors do. They give you small money. Like, they have plenty money. So let me give him. The whole idea is he may fail, he may succeed. But if he succeeds, I'll make a lot of money. But if he fails, I've lost the money. And more typically what angel investors do, they take money they can spend in one holiday and give you. So what you see, typical tickets, maybe $10,000, 5 million, that kind of thing. Because an angel investor is somebody who can buy a small car for 5 million, groove one weekend. Just, okay, give you weekend money. Let me see if all this noise you are making, whether you can be successful. So at that level, there's extremely high risk, and that's why it's very difficult for you to get funding from anybody. So first of all, the entrepreneurship journey is very tough, very lonely, because nobody understands. In fact, a lot of people see you as somebody who is not well. You see people and that's why you see the way they even behave sometimes. That's why you see entrepreneurs don't sleep. They work Monday to Sunday. They do crazy things. So at that level, the risk is high. But the problem is this: you can't focus on costs at that level, because remember, you don't even have a business. What you have is an idea. What you have is something in your head, So you telling the person to manage costs without telling him how the cost is going to help him achieve his overall goal is like you're wasting his time, because he knows there will be cost at this level. He's not planning to even recoup it at this level. Even people giving him money, they're not giving him money to generate sales or profit now. They're giving him money to build out the idea, so that if he can build it well and answer those 3 questions: 1, what problem are you solving? He's able to properly define it. 2, is there money in this problem? Can you make a profit out of this? What you call unit economics. Then 3, is it scalable? Can you put that solution in the hands of 1 million people, 10 million people, 50 million people to pay you for those kind of this? Just like Facebook. Let me use Facebook as an analogy. Facebook started with Mark Zuckerberg, we all know, in his dorm room at Harvard University or wherever. Many people don't know that one of his first investors is his father, who gave him $100,000. What he did was he built a website. There's a story of which he stole the idea from his best friends, a set of twins, who later eventually became very rich through crypto. The first set of investors in crypto are those twins guys. They took the money from Facebook when they sued Facebook and invested in cryptocurrency and became extremely rich. But that's the story for another day. So when the guy started, he built it. But he's spending money, don't forget. He's building servers. He's getting more and more servers. He's getting users. He's getting, And I think maybe at this point, let me introduce a concept to this. Every business, right? Every startup is an idea. There are people who are experts at different levels of businesses. There are idea generation people who will come with ideas, start it up, and they are growth specialists. So the whole idea of you being a startup is come up with that idea, build it to that point. Forget the cost. You will always burn money. It's a high risk. By the time you take it to a point that makes that business attractive enough for a growth specialist, they will take over that business. About the Facebook story. I have $1 million idea. Peter Thiel told him, no, this is $1 billion idea. And Peter Thiel is a growth expert. He knows how to take a small business, get the right people to put money in it, and blow it up. So that's what you see most startup people do. They want to get to that point where they have something that can be shown, then get investors who will not just put in money, and also bring in expertise, bring in their network relationship to be able to expand this business to a point where this, what looks like loss today, will be recovered in a bigger way in the future. So that's why you see most of them don't focus on that cost at the early stage. The risk is high. But yes, you know that by the time you are able to successfully do this, the reward is insanely better. So when you are having a conversation as a finance business partner with a startup burning cash, don't just say, we are burning too much cash. Sit with him or her and understand, what is your game plan? What is your business model? What is the 5-year plan for this thing you're doing? How do you plan to make money? How do you plan to cover this loss in the future? It will give you a different perspective to what's kind of, to how you think about the business. And that's why I mentioned it's all about relationship business. It's all about relationship. It's all about communication. It's all about negotiation. That way, you are at that point, you see that you are no longer the accountant looking at loss month on month. You are no longer the analyst looking at unit elements of it, but rather you are now a business partner to be able to say, wow, okay, so this is where we're going. We know that we're going to burn 1 million, 100 million naira in the next 2 years. But after that, what happens? So there we set key metrics. Okay, every month we must get 100 new customers, because by the end of 2 years, we're going to have 1,000 customers who will be paying us this amount. So you now start to track those KPIs. So that's how you, as a finance business partner, will effectively add value to that startup. It's not just saying we are losing money, we are losing money. Of course, he knows he's losing money. But the question is, what is the long-term plan of that loss? How do we recoup it? By the time you ask the right question, have the right conversation, you will see that your mindset will change from just cost to rather investing. You're actually investing to build a business. I hope I've answered your question.
Yes, you have. Thank you.
Okay. Okay, any other questions?
Okay, I have a question.
Okay, good.
I think I will go after Ayo.
Okay.
So, from my experience as a finance business partner, using the Nigeria business environment in Nigeria business environment today, so what's the expected, like the number of years you think a startup is supposed to break even? Because now we're trying to talk about adding value to the business. So as a finance business partner, I can't waste time with the organization thinking it's going to break even. So if it does not break even, so from my experience working with many startups, like what's the number of years is expected a good startup with a good business model is expected to break even?
Okay, so typically people throw around the numbers 5 years, but from my experience, it doesn't always work like that. And here's the reason why it doesn't always work like that. First of all, it starts with every business you see, even with the ones that just start up with idea, everything, at some point have what you call a business plan, where you do a financial forecast for the first 5 years to say, hey, this is how we're going to generate money. This is how we're going to grow. And at this point, we become profitable. They share to investors. But now, typically what happens after every year, maybe after every year or every 2 years, when the business starts to grow, the owners of the business, the board of directors, everybody sits down and analyze the numbers to say, hey, okay, well, are we meeting our targets? Are we heading towards our KPIs? If we're not, what should we do? So, I give a typical scenario. Amazon, like I said, Amazon did not make profits till 10 years. It wasn't like Amazon wasn't making money. They didn't break even till like 10 years. It wasn't like Amazon wasn't making money. Amazon, after like 3 years, I think, I'm not sure right now, but I need to verify. After it, but the investor said no, keep expanding. So what they were doing is they created a budget for research. So in research, rather than money as profit and keep it, they spent it as an expense to research new markets, new products, new ideas. Just keep building. Because two things come to play. There are some things that you will deal with after a while. For example, tax efficiencies. That's one thing investors also are very conversant. Some investors use. Maybe some of you would have heard of putting in tax havens. You've heard of countries they call tax havens. You hear of things like British Virgin Islands. So the most little of those things is you don't want to pay. They don't want to pay, or they want to pay the most tax on their investment. Because if you put money in a company and you are making those profits when you sell your shares, you're supposed to pay tax on that profit. But there are ways around it that these startups or these companies know how to play and dodge that. So some of those things affect when a company breaks even. At some point, maybe year 2, year 3, you start to realize that, hey, we figured this thing out, man. We have an opportunity in Ghana or your opportunity in Kenya or wherever. What do you do as a startup? Then the owners of business start to think, should we start keeping this cash as profits? And just keeping the profit and distributing it as dividend, or do we set up an investment fund or a research expense to go and research how to build this business in Ghana? And a decision is taken, and you see that 10 years down the line they are not still making profit. They are generating cash flow, but they are not making profit. So typically the rule of thumb for everybody is 5 years. If you are not profitable, or if you don't have a direction to profits, or you don't even know how you're going to make profit or whatever it is in 5 years, as a business, they will tell you either you make iteration, pivots, or just close the business. But we've seen facts that suggest that, look, it's not necessarily 5 years. It depends on when the owners of the business, once you figure it out and you're growing fast enough, it depends on when the owners of the business want to turn in profit. E.g., Facebook. Facebook did not charge anybody a dime for its first 7 years of operation. Facebook would have started charging money and they'll make profit there. But they didn't. Amazon was growing, was not taking profit. They were investing it back into the business and expansion. So, and I think it was after the 10 years, they started to record the first profit as a business. So many other startups you have like that. And you see a lot of startups you see today, I can assure you, don't make profits. You might see some of them, in Nigeria, have been around 9 years, 10 years, make so much noise large. I can assure you, they are not making any profit. And they've been around for long, and investors still keep putting money in them. Because don't forget, right? I think, maybe that's another thing I need to explain. There's the last stage of this slide on my screen, the exit stage. Every business has an exit plan from day one. So exit plan for each business is not the same. Some plan to exit by doing IPO, meaning that it's a profitable business. We take it to the stock exchange, Nigerian stock exchange. We sell shares to public and people buy the shares. Then we can sell our own shares and we'll go and retire. Some exit by building what you call a platform. So what does that mean? I remember then in Jumia, when I was there, one of the things we used to say was we were building Africa's Alibaba or Africa's Amazon. So the whole idea then was build it such that when Alibaba or Amazon wants to come to Africa, they don't need to start to spend the same money to acquire the same customers. They don't need to build the same infrastructure. All they have to do is acquire the business and they can rename it to what they want. So that's another form of exit. So at that point, the goal is not profit. The goal is to acquire customers, to get everybody to create an account with Jumia and buy at least once every 3 months and at least use Jumia Pay to make payment, to gather as much information, data. So some of these companies also need to mention that they're actually data businesses, not necessarily what you think. And that's where what comes into the play and selling. They are into data. They are selling your data. They know. And that's why you see by the time some of them send you your report, maybe bank, they'll tell you average spent on expenses. How many of you notice that when you are going around, sometimes Google will be making suggestions to you and all that? That's data. That's what some of these businesses do. They don't really do the kind of business you think they are doing. They are actually into data. So to summarize, to answer your question, there's no right or wrong number of years to make profit. It's always a function of the owners of the business and it's always driven by their exit plan. So when you are working in a startup, you need to engage whoever it is that what is dimension is that, okay, so that's why we're not even thinking of costs. That's why we are focused on. You see a company making loss in Nigeria, opening office in Ghana and other places. You wonder, are you well? You're not even broken even here. You are thinking of other places because their business model is never to make profit. The business model is to build it such that when a big player wants to come into this market, they just acquire, just like what did happen to Paystack. Paystack was acquired by Stripe. Paystack was not interested in profits. They won't tell you that, but the truth is they were not. They are just acquiring users such that when a Stripe wants to come into the Nigerian market, they don't need to start and register company and go through that process. Paystack has already built it. So all you have to do is speak to the founders, tell them to sell some of the shares, and that's it. So there's no right or wrong rule. First thing is engage the owner of the business or the owners of the business and say, what is the exit plan of this business? And once you even start using those types of words, they know that, okay, this person knows what he or she is doing. And it will now help you define how you think as a finance business partner and help them measure the important KPIs. Hope I've answered your question.
Yes. Ebenezer,
Okay. Thank you so much, Mr. George.
Okay.
You actually did well answering, I think, my first two questions already. But then I think I still have something bothering me, especially in the kind of era that we are, where there is this very big transition, like especially amongst even young professionals So I would like to what would be your advice for a young professional that is with maybe a startup, for instance? To what extent do you think the young professional can go to like pledge allegiance, and of course, just like you explained, like with with the idea of the long-term goal of the startup, to what extent do you advise that the young professional like stay or be willing to stay with the startup, basically? And then secondly, like, can you like give examples of how young professionals like I am, okay, can you maybe cite a case of yourself, like how you were able to like grow as a finance business partner? At what point did you like make finance business partner? What were the things that you actually did?
Okay. To your first question, rule number one, there's no loyalty, there's no allegiance or anything to any company. Don't forget, you're building your career. It's a value, it's a service. That's the first rule you need to understand. You're providing a service to the business or company and you're getting paid for that. Don't forget that fact. And why did I say that? Because let me tell you what happens. If you put in so much and the business dies, you will feel bad for yourself. That's one. Then two, if you put in so much, because it's putting so much to do the work, then the business starts to grow, then you think, okay, as the business is growing, you're supposed to grow with it. Sometimes it doesn't happen like that. You just get, this man will call me, midnight, we'll work together. Now, for him to promote me to become head of department or whatever, that's when he starts to realize that, okay, he has this thing. Now, sometimes they don't do that out of being wicked or spitey, but like I said, there are different stages. At the early stages, they do it alone. But the moment it has to get to maybe growth stage and co, they would have gotten investors who would have put in money. And after they put in money, they will now bring in people, because those investors, like I said, they call them growth experts. They'll bring in people who are experts in those fields, who know this thing more than you. What you just have is the raw knowledge. Like, okay, we've been doing it together, I've been struggling. But the reality is, when you want to grow, you can't grow with the same struggle mindset. You now need to start to put in some level of structure and expertise. Now, I'm saying this because I'm trying to remove the emotions. But it hurts, believe me, when you're in that position, when you believe that I've been doing this thing, suffering, or now there's money. Life is not supposed to be easier. They bring all your guys in this world. And half the time, you now realize the person they bring doesn't even have a clue. You're still the one teaching the person. So it will be very painful for you. So you might not necessarily say loyalty or allegiance. That's what I'd say for that. But very importantly, remember, you're adding value to the business. It's a service, and that's why you're being paid. If it's free, it's a different thing, but you're being paid. So you're an employee. It's your job. You are doing your job. You just want to do it very well. And in the process, you're adding value to the business. And at the same time, you're learning. You're adding value to yourself. Very important. Very, very importantly, you need to add value and learn. Then the other part, which you said, how did I know, or how do you know it? Now, it's very interesting. Why? Because remember, one of the things I mentioned at some points is the competency and the mindset. So first of all, you need to understand there has to be a mindset change. You can't say this is how I was doing it where I was working before. This is how they said we should be doing it, and expect it to work like that. So first thing, what I always try to do is I always try to put myself in the shoes of the owner of the business, right? And in doing that, that's why I asked the questions I mentioned earlier, like, what is the exit plan? What is the business model? What is the goal of why are we even running this business? Some may not tell you, but with time, they see that, okay, you can keep things confidentially, and you are really mature and sincere about it. They will run you through it to explain to you that, look, I am not doing this because I like this company. Believe me, it will shock you when you hear founders tell you that. I've heard a number of times, I don't care about this company. I've heard it a number of times. What I'm trying to do is build something that I can sell. And as an entrepreneur, I've found a problem, I've found a solution. And this is the solution. And I believe that if I can build this thing, I can sell it, I can make plenty money, get investors to put in money, and I exit. I worked with somebody that his attention span for any startup is like 3 to 4 years. He has built multiple, and I see he's still building a very new one now. He's always building startups. And if After 3-4 years, he will leave. But he builds it fast. He puts in his everything on that business. And he will fall sick, do everything in there, but he will still build it. And when he reaches that 3 to 4 year mark, he exits. He sells it. He sells his shares, allows other people to take over, and whatever happens to the business afterward is no longer his problem, whether he survives or not. So for me, what I did was I changed my mindset. I'm like, okay, it's not easy. I'll be honest. That's why I mentioned that I am an accountant. Somebody is telling me to give out something of 1,000 naira. This is a real life scenario. It's not just an analogy. And we only make 200 naira on it, and the customer is in Maiduguri, and they are telling me to use 3,600 naira to deliver that thing. Am I insane? I'm only going to make 200 naira and I'm going to spend 3,600. That is mad loss, But in understanding the business, after I had the conversation with the owner of the business, he now explained to me that, look, I am not building a profitable business. I am building a platform. What is a platform? The vision of my business to build a marketplace whereby buyers and sellers will meet. And in there, when we do that, what do? We are going to demonstrate that we can fulfill this order and deliver to everywhere in the country. So automatically, the person who is able to order an item in Maiduguri will tell like, wow, do you know that you can buy this thing from this platform and get it in Maiduguri? And before you know it, you have 2 customers, 5 customers, 10 customers, 100 customers. Then at that point, I can build a proper logistics business that will focus there, and it will make my cost of delivery cheaper. And I said, look, how do you justify this? I'm telling you a real life scenario. How do you justify that in my P&L? Because I can't put loss of a 1,000 naira product and loss of 3,004. I said, it's not in your P&L as cost of sales. It is in your P&L as marketing expense. That I can spend the same money on billboard, I can spend the same money on TV advertisement, and will not generate me anything. But rather, I know that this is an actual customer, that I have his name, phone number, address, their age, demographics, location, those kind of things that I need. An email, and subsequently I can engage him to buy more. So my next thinking will now be, how do I build a logistics problem to serve customers in that area that will make my delivery cheaper? And the house, don't forget, is also an aggregation, which is what he said. That look, for example, that's why I learned a little bit about aggregating deliveries. For example, you buy a bike, a delivery bike or a delivery van will not only go from here, there to deliver one product. Don't forget, it will deliver like 10, 15 products. You spread that same delivery cost across all those products. At the end of the day, you might make profit, you might not. But the bottom line there is you have been able to satisfy customers there. And now your customer base is increasing. They become return buyers. And later you can even partner with a DHL that can deliver to those areas. Now, why I'm saying this is this. For you to understand how I went from the mindset of an accountant in just a short conversation to say, he's looking ugly because you want me to use delivery costs, which I will charge my freight outward before I see my gross profit, Abby. And telling me to show a loss. And he's telling me, no, it doesn't sit in that part of my P&L. It sits as operating expenses, as part of my marketing cost, which is customer acquisition team, that rather than spend 10 million on a billboard, give me 5 million of this billboard money and let's use it to do this delivery. And is average data of what is the average spend of customers on the platform. Do you understand? Because they first started, they've tested it before, free delivery in Lagos, and they saw the number of people who buy. They secondly showed me the demographics, that how many people do I think will buy from Maiduguri that I'm looking at? What do you think is the effective cost that no matter what, it doesn't expect to get more than 20 or 30 people at once? And lo and behold, by the time we finish the whole exercise, I don't think we've gone up to 10 people. So, and he's saying that here I am worrying over 30,000 naira, telling him to worry over 30,000 naira when he can put it on his pitch deck that it delivers nationwide, which changes the way the business is perceived and dimensions. That once he puts it on his website, we deliver worldwide. People there will believe, and you can make a big noise about the person you deliver to in Maiduguri with the picture and everything, just to show that you actually deliver worldwide. So at that point, my mindset was starting to change, which is what I'm telling you, intellectual curiosity, continuous learning. I'm learning. I was learning. I wasn't rigid that, no, IFRS 1 says this, going concern effect, because the company is continuously making loss for the last 12 months. It has going concern issues, those kind of things. I wasn't. My mind has started to change. Go value. And the funny thing about it, when your mind changes, you won't even know. It's until maybe 6 months down the line, somebody is having a conversation, you see that you don't react the way they react. When someone says, that's it, they made loss. So you don't get bothered. Yeah, let them make loss. You know that in 3 years down the line, whatever they've lost, they will recover it by the time they start to make profit, because this is the potential size of the business. So that's what I will say worked for me. And I think that's what will also work for you. Be open-minded. And very importantly, build relationships such that when you're having conversation, you are not going to those conversations as an accountant. You are going to those conversations as a scholar. You want to learn how they think. You want to learn how the salesman think. You want to learn how the procurement person think. You want to understand the business. You're putting yourself as the owner and the founder. You understand this is where the owner and founder wants to go. These are the hurdles he needs to cross. That way you can provide meaningful advice and insight to how the business should do it. So I don't know if I'm able to answer your question.
Yes, please, Mr. George. Thank you so much.
Awesome.
So grateful.
Awesome. So any question?
Yes, I think Akemi Daniel is raising his hand. I don't know if you have a question.
Yes, good evening.
Yeah, good evening.
Can you hear me?
Yes, loud and clear.
Thank you so much. Thank you so much, sir, for this session. I really appreciate for all that you have done. And you have actually answered a number of my questions, but I just want to ask this question. So apparently, I just got an offer to work as a financial accountant in the startup. And all what you have been saying has really answered a lot of my questions. But in this startup that I'm about to get into, I discovered that they just started last year. And then just doing a quick survey, I see that they are just giving their staff a lot of goodies. Like when you come to the system, they give you a MacBook. I know that this company cannot make profits. So what we're just sharing now is okay. Maybe they have a bigger agenda.
Exactly.
But what I wanted to find out is that how do I know the stage of the business? In your presentation, you talked about the different stages. So how do I know the stage of the business? Is it at the pre-seed stage? Is it at the growth stage and all that? And how is it basically done? That is the investment that they receive from investment. How is it actually treated in the books?
Okay. Everything is treated. When investor gives you money, what is it? So it's either it comes in the form of deposit for shares, or what you call deposit for shares or actual share acquisition. Now, normally the process of shares for many organizations is somebody will give you money that want to buy shares. You must do an agreement. Then you must now go to maybe CAC to update your records there. You ratify to say to Mr. AB, blah, 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 get those documentation. Now, by law, you can't treat it's under that equity and reserves section, though. But you can't treat it as full capital until it crystallizes, in the sense that, yes, you have money, you have an agreement, but it's not been updated, maybe with CAC, to say that is your shares. So it will sit in there as deposit for shares. It's sitting there as deposit for shares for you. Some, depending on what they want. But reality is most founders and most investors will tell you where you treat it in the books. Because what typically happens, let me tell you, is from a lot of startups I've seen lately, and I think it's happening for a couple of years. most of the investments are not done here in Nigeria locally. So most of them always have what you call a holding company. A holding company in a tax haven, like I mentioned earlier, in maybe Mauritius, in British Virgin Islands, in Cayman Islands. Those countries, you don't pay tax on those type of income. So they put the money in those businesses registered in those countries. Then the holding company sends it to the local company here in Nigeria. So sometimes it can be due to or due from, meaning that the holding company will borrow the local company. So, but the truth is, from conversations with the owner of this, they'll tell you where to treat it. So that one's not your headache. Take it from me. They won't expect you to. Most times, believe me, they will tell you, put it in due to or due from, or put it in capital and equity, or put it there. And the entries are simple. You credit there, you debit bank, because money is sitting in your bank. It's the only worry where you're figuring out is where to credit. That one is very straightforward. Now, you said the company gives out MacBook and co. From my experience, I would say, first of all, do they have any visible products? Do they have a website? Do they have a platform? Do they have a product? Yes, they do.
They have a product. They have an app.
So obviously, they are no longer at pre-seed stage. Meaning because they built something. They have probably an MVP. Do you know if everybody is using the app or anything at all?
I think we said last year they have like 10,000 downloads.
Downloads is different. So let me give you another warning today and an experience that you will know. Downloads is different from people using it. Take it from me. I can buy downloads with as little as 100,000 naira. I can buy 1 million downloads on an app. I can assure you that for free. These are industry secrets that you won't know until you get in. By the time you get in, so these are some of the things you learn. By the time you start to engage, you realize, this thing is just BS. You will see them buying media. So you just when you see businesses start to do that, they are trying to raise funding from international investors. Because when you reach out to an investor with your pitch, investor will write you. Investor will first Google you. That's the first rule. They will type that name of that business Google. So if they see that you've appeared in Forbes, you've appeared in CNN, CNBC, it gives you credibility. Before they come to eventually see the real numbers in the system, those are some of the things you will see by the time you get in. Even the numbers sometimes, they are not real. I can assure you might see in the system you have 1 million customers. But in reality, but like I said, it depends on what the exit plans are. If you're using a plan that is not proceed because they already have something in there, that people can use. You said they are download. So one of the things I would suggest you also do is download it, try it. If it's something that is available to everybody, try and use it, or ask around, see people, whether some people have used it. So most likely they will fall for me at early stage, based on the way you describe it. Because seed stage, you are still trying to build the MVP. The whole essence of seed is somebody is giving you the money to assemble a team to build that product. But you said they're already there. So, and you can see they have started hiring people. I can assure you most seed stage businesses don't have accountants, because they will see you as a cost center. You'll be telling them what they don't want to hear. We don't have money. Expenses. So what they probably do at that level, most times at seed stage, is they outsource it. That's when you see them having outsourced accountant. But early stage, they've built the product, the MVP, and they now want to expand. So most likely, I can assure you they are sitting at the early stage level, because they have an MVP and they are building a team around it. So if it's growth stage, you said they have just, okay, so they definitely cannot be at growth. They can't be at growth yet, because do a quick research on them also. Google them and see if they've raised any funding. Just say,
I did a bit of research on them, and okay. I saw something about venture capitalist stage 4.
Okay, VC4.
Yes, that's what I saw.
VC4 gives seed funding. VC4 doesn't give much. I think their ticket is like 20K. They don't give you much, so they are they are early stage. Believe me, they are actually early stage. If it's growth stage, you'd have heard them say they've raised Series A, or they've raised Series B, or raised Series C. So early stage is mostly seed, and most very likely Series A. So if you built the MVP, like you said, they've now started getting people to use it, and they are still learning right now. Take it from me. That's why they have few users. Customers will complain the app is crashing. They'll quickly update it. Okay, it's no longer crashing. Oh, we can't click on this. They are at that stage of the business. So they have the MVP, they are learning. That's why I put it. They are learning from mistakes, to keep learning and learning and learning until they get to a point, at the MVP stage, you can build functionalities that you realize that people don't even want it. So you might need to quickly remove it, but the whole difference between the seed and the early stage is early stage, you have a product that is out there. Build a banking app, you put 15 features there, but reality is people don't use more than one feature. People want you connect WhatsApp, you can send picture, blah blah blah. Nobody cares. You log in, do transactions, and go. So most likely they are in early stage.
Yeah, you're right. Because during the interview stage, I asked the question. I said, because the kind of computers we have are like HIPAA.
Okay.
So they have that functionality. And so I asked them during the interview stage, and they said that they are getting, for now, their customers don't use that functionality.
Exactly. So you have your answers. They are early stage. They are validating their minimum viable product. They'll do is think of more funding. Once they figured it out and they are able to know that data, they will start to look for funding to expand it, to spend on marketing. Like, it also by the time you get in, their conversation will also determine some things. It will help you clarify. One, they will be talking about we want to raise money for marketing, or want to raise money for people. Then you know that there are growths. So, but at the early stage, they are raising money to build the tech. They are focused on more tech people. You need a developer, you need a front end, you need this one, that one. But by the time they are getting to growth, we need the growth marketing person. We need someone with expertise on Google marketing and digital marketing. We need a finance person to ensure compliance.
Yes, exactly. Specialist.
Because they are looking at growth, and the reason is for a growth investor to come in. Growth investors are always concerned about compliance. So growth investor will ask, do you have pension liability? Do you have tax liability? Do you file your annual returns? That's why they are bringing you in to help get those things off the way. They need someone in a finance function, because if they don't have someone in a finance function, a growth investor will not give them a dime. I can assure you that. But you learn with time. So it's a very good opportunity to learn, except you have something else to do. If you don't have something else to do, give it a shot, have fun, try as much as possible to learn everything possible. And like I said, relationship, have conversations with the founders. That's the advantage of startups. You have opportunity to speak to the owners of the business, and they'll tell you, initially they may dribble you, but they'll tell you later, look, I'm not here to a bigger company in Europe. That's the goal. They will even show you their real revenue model. Finance business partner, like we run also. It's a startup. We've not made money. We've not done anything, but people are investing their money and time into it. But it's free. You are here free. I'm paying for my internet. Every other person is paying for the daily research and everything. But it's free to you. You are not paying it. But it's not free to us. We are paying for our internet. We are paying for our time to do research and everything. But the goal is not to make money from you. The goal is to see, is it possible to make money from someone else? And it's a 50-50. What if we're thinking this way? What if it doesn't work out like that? So you'll learn along the process.
Thank you so much.
Mm-hmm. You're welcome. Any other questions? Okay. So we don't keep people for long. If there's no other questions, I think we can end the session. I think we've tried a lot. I mean, if you have questions, you can always drop it on the. Be happy to engage and share ideas, rub minds together, and have these conversations.
All right. I'm not sure if we have any more questions for today's session. So thank you all for joining us today. So we look forward to having you guys next month. So next month, meet and chat. So while for the slides and the recorded session of this video, it will be available on the group and other social media handles. I think that'll be all. See you guys next month for our next section. And
all right. Thank you, guys. Thank you. Thank you for coming, and have a lovely weekend and week ahead.